Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include biometric data and mortgages, my interview with Figure's Anthony Stratis and West Capital Lending's Arthur Greenbaum on the power of partnership and why they're excited about Figure's new AI-powered DSCR platform, and mortgage applications continued their slide in the latest data. Today's podcast is brought to you by Flowify, an industry-leading point-of-sale platform. With Flowify's new dynamic AI feature, lenders can modify applications with no coding required and rely on AI to autofill key application fields, allowing borrowers to fill out only a few fields relevant to their needs. The result? Faster completions, fewer drop-offs, and smoother approvals. Discover smarter lending at flowify.com or visit Flowify in person at MBA Annual. While the debate rages on about whether the three colors of candy corn taste different, at the other end of the tech spectrum, lenders are weeding out unused or out-of-date technology, reviewing new tools, all the while looking at bad developments in the IT world. Speaking of, did you know AI companies are paying people to fold laundry in front of robots so they can learn to do household chores? It's disappointing that we may never get to see a robot tangled in a fitted sheet. JP Morgan Chase isn't taking any chances getting tangled at its brand spanking new $3 billion headquarters in Midtown Manhattan. So it's requiring employees to offer up biometric data in order to access the building, located at 270 Park Avenue. The ongoing federal government shutdown, now entering its third week with no resolution in sight, has had a limited immediate impact on the economy and markets, though 600,000 employees have been furloughed and all 12 annual appropriations bills remain unsolved, making this one of the most expensive shutdowns in recent history. While the economic cost is currently modest, estimated at 0.1 to 0.2 percentage points of GDP per week, concerns are rising over potential disruptions to key data releases. Meanwhile, Chinese and U.S. politicians continue their ongoing trade war. The shutdown is also shaping expectations for monetary policy, reinforcing the likelihood of a Fed rate cut in October and making the December FOMC meeting increasingly pivotal, as delayed data may create a compressed and more volatile decision-making window for policymakers. Fed Chair Powell spoke yesterday, signaling the central bank may stop shrinking its balance sheet in the coming months. He also indicated U.S. labor market prospects continue to worsen, a message that supports investors' expectations for another interest rate cut this month. Fed officials have been winding down the central bank's balance sheet since 2022, reversing trillions of dollars of asset purchases designed to stimulate the economy after the pandemic struck. Earlier this year, the Fed slowed the pace by reducing the amount of bond holdings it lets roll off every month. As Prime Lending's Andrew Stringer put it, quote, "The most obvious pressure point is labor market weakness. We're now looking at nearly 1 million jobs retroactively removed from the books due to survey inconsistencies. September's hiring plans were the lowest in 14 years, and seasonal hiring is projected to be the weakest since 2009. With the shutdown disrupting key data releases, we're flying blind on the true unemployment rate, though it's hard to reconcile any meaningful drop from the last reported 4.3%. On the other side of the scale, long-term yields continue to climb as investors demand more compensation for inflation risk. The 30-year yield is being driven up by concerns over persistent price pressures and fiscal imbalances. This tug-of-war between labor softness and inflation anxiety has kept rates range-bound for now. But unless Powell signals a higher terminal rate, resolution remains elusive, especially with potential trailing tariff effects still looming. Volatility is likely to rise alongside the environmental risks already in play. Mortgage rates remain elevated at around 6.3%, partly due to a still wide but narrowing spread between rates and 10-year Treasury yields, which peaked at 317 basis points in 2022, but has recently compressed to 217 basis points, closer to the historical average of 175. This narrowing is driven by further clarity around monetary policy following a recent Fed rate cut and expectations of further easing, alongside a steeper yield curve and reduced rate volatility. Additionally, improving supply-demand dynamics in the MBS market, particularly stronger demand from private non-bank investors, are contributing to the tightening spread. For today's interview, I wanted to welcome to the show Figure's Anthony Stratis and West Capital Lending's Arthur Greenbaum to talk about the power of partnership and why they're excited about Figure's new AI-powered DSCR platform. Yes, Figure has launched the industry's first AI-powered DSCR loan platform, and West Capital and Axon are among Figure's first embedded partners as the company expands its blockchain-based capital market. With DSCR originations up 123% year over year and monthly origination volumes exceeding $2 billion, Figure's solution gives investors access to flexible capital for investment properties. qualifying based on property cash flow instead of personal income.
It was announced this morning that Figure has launched the industry's first AI-powered DSCR loan platform. Westcap and Axon are among Figure's first embedded partners as the company expands its blockchain-based capital market. Very excited to have Anthony Stratis back on the show from Figure and Art Greenbaum on from Westcap to talk about this. Anthony, Figure's been known for HELOCs. That's been the bread and butter for a while now. But DSCR loans have been a super fast growing segment in non-QM lending. Maybe let's step back here, talk about the journey, talk about what you're seeing from the DSCR space and kind of the timing of this deal.
Yeah, sounds good. So from my perspective, I think we've done a really nice job on the HELOC side, and we've sort of gotten a good critical mass where we've been able to leverage a lot of the automation through our process, a delightful customer experience, being able to significantly cut costs, deploy AI where we can in the fulfillment process. And, our strategy has always been to take that foundation that we've built and then redeploy it to other areas of the market that we think are really ripe for benefiting from those same capabilities. And so DSCR was a natural next step for us. We think that there's a ton of growth. There's already a ton of demand, and there's a lot of growth that's upcoming there. And so what we have essentially done is taken those capabilities that we built HELOC on top of, deployed them to DSCR, and launched with a few pilot partners, as we just mentioned, and looking to expand to many, many of our other partners that we already have in place. So maybe, Art, you're probably even better positioned than I. Maybe you could talk about the demand as you see it from your seat.
The demand for DSCR has been growing exponentially. We have a lot of our people here at West Capital that focus solely on that customer segment. You have a lot of people who still see a lot of value in basically being landlords, having those, mostly long-term rental properties and the cash flow that's derived from those. And that's where DSCR really comes in and, is a huge play because it's much easier than your traditional type financing, and it focuses only on the cash flow of that one property. So, it's all focused on just that one property. And a lot of these people have very significant portfolios. 10, 15 properties is not uncommon to see. And this is a much better and easier product for them than going the traditional route of conventional financing and the limitations that it provides.
Well, I'm hoping we can dive into that a little bit because DSCR isn't new, but it is different from the conventional approaches that other lenders are using today. Can you address that briefly?
Basically, it all comes down to this one property cash flow, right? Simple terms. Your mortgage payment is $2,000, your rent is $2,000, the property cash flows, you qualify. I don't care about your car payments. I don't care about your other properties, what those are, other than, you're paying those payments on time. But other than that, you don't have to get into too much detail with those. A lot of these people also, the very savvy investors, may create individual LLCs for each property. And so that can be a little convoluted if you're trying to go the traditional agency route with financing. DSCR is very open to that too. There's a lot of benefits to the product in terms of it not, because it is an actual business purpose loan, traditionally basically a commercial loan product on residential real estate, that it doesn't report on their individual credit reports. And so it doesn't, clog up their credit report with 10, 15 mortgages if they're trying to do, let's say, primary house financing or other types of, consumer financing. So it's a really innovative product. And when you start looking at it with the LLPAs that have been brought in, with Fannie and Freddie, for instance, on investment properties, the pricing is almost on par with what you're going to see with going full documentation agency compared to what you can do on a DSCR loan.
Yep. And then from my perspective, we were seeing a lot of demand for investment properties with our traditional HELOC, right? But what ended up happening is that we were underwriting, to Art's point, to the individual's income rather than the property's income, which for many borrowers is a perfectly valid approach. But for those that have 10, 15 properties where maybe, their personal income doesn't quite justify additional loans, going the DSCR route and looking at the property and how it cash flows is kind of the yin and the yang for how you can get extraction of that equity.
I'm also wondering kind of the value of partnerships here, whether it's lenders, brokers. The biggest advantage of embedding Figure's DSCR product in to their offerings when it comes to competition and growth, things that everybody's trying to do these days?
Sure. So I can take that one. I think from my perspective, we already have a number of partners. I think we've said we have over 200, right? And those partners are doing significant HELOC business with us. Being able to turn on additional products like DSCR is a natural next step. There's really not much work involved, and you still get the benefit of the standardization, the automation, et cetera. The other thing is DSCR is very fragmented. There's dozens of lenders that pursue this. Most of our partners already send loans on a brokered basis to many of them. And we think that having it in one place in the same dashboard for a given LO just enables them to have yet another option that we think is really compelling, given a lot of the benefits that I already outlined. How do you look at it, Art?
Yeah, I mean, to show with what Figure has done with the home equity space already and how they've transformed that and the ease that has been brought to that, DSCR and other future products, I think, are just the next evolution in what they're going to bring to market. And like I said, we have a lot of people who do a lot of non-QM here at the DSCR space. And I think having this as like an option and the technology that comes with Figure and the streamlining of some of the processes involved, even though the DSCR loans can be very easy, there still can be a lot of steps to go through and verifications that need to be done. And with Figure's platform and the technology that they bring to play into the finance space, it's a logical step for this product to be a part of how our growth is.
Yeah, well, Art, let's talk borrower benefits here a little bit. We mentioned lenders and brokers, but for borrowers, investors, small business owners, kind of the typical DSCR borrowers, how does this change their experience? Or I guess I would ask kind of in a giddy sense, what's funding in as few as 5 days look like in practice for them?
Like for instance, with the home equity loan, it's about ease of process and speed, and that carries over into DSCR as well. The fact that on this product you can do AVMs instead of having to have full appraisals completed. The fact that you can bypass a lot of the hassles with full traditional title and escrow just eases up the process. One of the things on DSCR that you always do have to verify is all of the mortgages that you have are paid on time. So there's more manual process being done there, but with the processor involved and with the borrower involved on verifications there. Figure has found a way to basically streamline that and make this about the easiest DSCR that you can do. A lot of these people are sometimes looking for very quick money. We see a lot of people who did fix and flips. They're trying to get out of that hard money as fast as possible. And the quicker you can get them out of those hard money rates and into long-term, DSCR rates, the more beneficial it is for them.
Westcap here, this announcement that came out today, you were one of the first to embed this DSCR product. What made you confident in Figure's approach? And how do you see this partnership shaping the future of investment property financing?
Complete and utter faith in Figure. We have an amazing partnership with them already as their number one HELOC partner. Once that product came on, it grew. It helped grow the company. I know it's been symbiotic relationship between Figure and West Capital on growth on both ends, and just knowing how they could execute on that once they had that product and any future products, we know no question we're going to onboard those products and run with them.
The Figure's combined AI automation, it's blockchain standardization, which I've been excited about for a long time, all in one platform. These two technologies, you've obviously, the market now has taken notice that it's made lending faster, safer, more efficient. I'm ready for primary originations, first liens on primary residence. People are getting a mortgage, 30-year fixed rate mortgage, to incorporate some of these Figure processes. Can you walk us through just how it makes for a better lending experience, how it makes things faster, safer, more efficient?
There's clearly borrower benefits that Art just mentioned, right? You get solid rates that are really driven by the fact that we've taken a lot of costs out of the origination process. Beyond that, it's a pretty easy experience for the borrower, but a lot of that percolates back to the LO too. We've made it easy for the loan officer to do this, and the easier you can make it for the loan officer, the more they engage with a given product. And I think that's driven a lot of the growth. So what does that mean in practice, and how have we done that? The funding in as fast as few as 5 days, as we say. A lot of it really is just trying to take out steps from the origination process and replace them with digital means. The easiest example that I always use is using AVMs instead of full appraisals where possible. Clearly, that's cheaper and faster, and that drives an experience. It's that much easier for a consumer. It's pretty cool when you could tell them how much we can lend and at what rate within seconds, rather than taking, a few days to do so. When a given consumer has, when you have their attention and they're looking at a deal, and when an LO is looking at a deal, getting that speed to offer is critically important for engagement. Beyond that, as it applies to DSCR, again, I said that we took a lot of the foundation upon which we built HELOC and deployed it to DSCR. We're using AI to look at rental income verification. We definitely do the same things that we do with title and lien matching, and trying to make that as efficient as possible. Any step in general that we think is manual, we have tried to come up with a digital mean of actually performing it so that we can, again, take costs out and move faster. That is the pillars upon which our origination is built.
Talk broader vision for where this leads Figure. Figure's already known as the number one non-bank HELOC lender, and now you're expanding into DSCR. But I know whether it's from the top down, Mr. Cagney, Mr. Tannenbaum, how this move fits the broader vision for transforming housing finance in the capital markets.
Absolutely. So on the HELOC side, again, we always talk about the fact that we've built a fully digital and automated underwriting process that then creates loans that can be boarded to blockchain, which is hugely important in adding efficiencies post-origination. We've built a capital markets ecosystem where those assets can freely trade between originators and investors directly and efficiently. And all of that creates a liquid and efficient ecosystem that makes pricing on these loans that much better to begin with. The natural next step for us is to look at additional products that can benefit from those same items, and DSCR is a natural next step for us. It is a loan that we think has tremendous opportunity to be sped up, automated, and standardized. And of course, that dovetails nicely in it being eligible to participate in that Connect marketplace. And I think my guidance would be that we're going to continue to look for other opportunities such as that in the market, where if we think we could do it better, faster, cheaper, and board it to chain and have it participate in our Connect marketplace, it's likely we're going to move in that direction. It's interesting that you mentioned first lien earlier, Robbie, and what we can do in that space. While we haven't done the traditional 30-year mortgage yet, I'd be remiss if I didn't mention that we do have a pretty strong first lien HELOC right now that on pricing is pretty competitive with agency pricing, especially for lower loan amounts, given how efficiently we can originate it and how we keep the cost to produce down. And that's something that we're absolutely pushing as well. It's still a HELOC, but it demonstrates how we are being creative in looking at the products that we have to address varying customer needs.
I agree. I think the first lien HELOC is a big piece of, what that product brings to market. Like you said, especially for smaller loan amounts, where a lot of times you try to go the traditional route, you're going to run into a lot of QM issues, qualifying them, and you still have to go through a whole process to maybe do, $50,000, $60,000 loan that you could potentially close in as simple as 5 days with, Figure. And I'll tell you that at West Capital, we're very, very bullish on the products that Figure already has and the products that we know are going to come down the line. I think they're transforming the lending space, and we're happy to be along with that for that.
It seems like everything Figure has touched has turned to gold. So I applaud the move from West Cap. I applaud the move for you guys, Anthony. I wish you the best of luck. That, and always a pleasure having you on the podcast. Thank you very much.
Thank you.
Thank you.
Today's economic calendar kicked off with mortgage applications decreasing 1.8% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending October 10th. Empire Manufacturing for October is due out later this morning, as are remarks from multiple Fed speakers, and I have to say, though, the market movement will be largely dictated by bank earnings, headlined today by Morgan Stanley and Bank of America. We begin Wednesday with agency MBS prices slightly improved from Tuesday's close, the 2-year yielding 3.47%, and the 10-year yielding 4.00 after closing yesterday at 4.02%. Let's wrap up with a joke and some housekeeping. My friend must think I'm gullible. He said today was the autumnal equinox, but I'm not going to fall for it. Thanks again to today's podcast sponsor, Flowify. With its new dynamic AI feature, Flowify delivers smarter, faster digital mortgage experiences that lenders can tailor to each loan type. Learn how to reduce friction, boost compliance, and close loans with more confidence at flowify.com or visit Flowify at MBA Annual. And don't miss them at the Tech Showcase at the Fountain Blue on Monday, October 20th at 3:25 in the afternoon.